Welcome to the Compounders Podcast, where we explore the anatomy of public company wealth creation stories. On this show, we invite you to be a fly on the wall for the actual conversations professional investors have with public company CEOs. I'm your host, Ben Claremont, a partner and portfolio manager at Cove Street Capital. In these conversations, I interview senior executives by posing the exact questions I ask as part of Cove Street's diligence process. Whether you are a professional investor, founder, or someone who is simply interested in business, we think this podcast has something for you. This season of Compounders, the Anatomy of a Multibagger, is sponsored by Tegas. Tegas is an innovative and disruptive company that is changing the way professional investors work. For more information, please visit their site at tegas.co.
All opinions expressed by your hosts and the podcast guests are solely their own opinion and do not reflect the opinion of Cove Street Capital or any affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The hosts and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable.
My guest on the show today is Jeff Bailey, the chairman and CEO of UFP Technologies. UFP is a $480 million market cap company that specializes in designing foams, films, and plastic materials for the medical, automotive, consumer, and aerospace markets in the US. Jeff joined the company in 1988 and became CEO in 1995. Jeff has been instrumental in helping turn UFP into the company it is today. After years of somewhat limited growth, UFP made its largest acquisition ever in 2018 of a company called Dielectrics, and that deal has transformed the company's margin profile and growth trajectory. And the big changes that have occurred since the deal have not gone unnoticed by the stock market. Accordingly, I thought it would be really instructive to hear from Jeff about the process that led to UFP's recent success. In this enlightening discussion, we will cover the genesis of the Dielectrics deal and the strategy surrounding moving into medical end markets, Jeff's thoughts on key elements that have allowed the stock to appreciate to a level 20 times its value when Jeff became CEO, the benefit of being patient and having a willingness to suffer as a CEO, and areas in which UFP still has a long runway to get better. Before we start, just one disclosure to note. Cove Street owns UFPT stock. And without any further ado, here's my conversation with UFP Chairman and CEO, Jeff Bailey. As always, we will start this discussion at a pivotal moment in the company's history. Let's start with the Dielectrics deal in 2018. It was your first big deal with an acquisition price around $80 million. Going all the way back to the early 2000s, I can't find a deal that cost more than $10 million. With the benefit of hindsight, our sense is that this deal has really helped change the trajectory of the company. But you took a huge swing relative to past deals and the market cap of the company. So the big question is, what did you see in Dielectrics that justified such a large bet?
Well, thanks, Ben. So Dielectrics was an exact match for what we were looking for. We had gotten into the RF welding business actually kind of by accident because of an innovation we had done for a customer to solve one of their problems. But it had grown into a multi-million-dollar business, but we were not best in class in it by any means. And there was a company only 2 hours from us called Dielectrics that was the very best. They used to manufacture the equipment themselves, both RF and impulse welding, and sell it. When problems were very difficult, they ended up on their desk and they started making some medical parts for people and realized that that was a better business model for them. So they stopped making equipment for others, got into the business, but there were only one plant. And we shared a lot of customers. In fact, we shipped parts to Dielectrics that they finished the device for negative pressure wound therapy. So they were the next step in the value chain. They were better at RF welding, could teach us for the balance of our business. They're a fantastic cultural fit. We felt we had negotiated a fair deal. And given their proximity and cultural fit, we thought it'd be a relatively easy integration. So with all those factors, they checked all the boxes and we were sort of all systems go on this deal.
It sounds like this is an asset that you were thinking about and kind of been thinking about chasing for a while. How do you approach, the management team or the owners there in a way that allows you to move forward and get a deal done? I'm always interested in when you've identified something, like what is the approach of how to get them to the table?
So that's a fantastic question. So basically we dialed the phone a whole bunch of times and don't get anywhere. And then in this case, we put a third party on it. So we work with a third party that sources deals for us that's kind of just a tenacious pit bull about getting us appointments. And so they work with about a list of 25 at a time. And so we gave us this one, and it took them a long time to get us a date. But when they did, it went quickly. So we used our third party to ultimately get in the door, although we gave them the name.
And given the size of the bet, I mean, I can imagine there was a fair amount of consternation within the boardroom regarding, it sounds like there was an easy integration. It was a good match, but it was a pretty large swing. So how much consternation and questioning of you was there within the boardroom regarding this size of a deal?
Well, our management team got unified behind this opportunity pretty quickly. So when we brought it to the board with all these different boxes checked, I mean, the board was very diligent in pushing back and how you're going to do this. And, this isn't a business that you're experts in, et cetera, et cetera. But they quickly got comfortable too. And so I would say not as much consternation as you'd think, given that they had checked so many different boxes.
That makes sense. And we've seen in a lot of instances that companies that had kind of legacy industry exposure and wanted to be in better margins, higher growth businesses, it's often really expensive to get into businesses like that from a multiples basis. And a lot of companies have not been that successful because they were so focused on reducing exposure to industry X that they either overpaid or didn't quite understand exactly what they were getting into in industry Y. So you've gone from like a very kind of like automotive focused company towards like heavily investing in medical, and you've done it without the wheels falling off. How have you been able to, transition at your end markets and in the way that you have?
Well, we did it over time, and it's kind of core to our strategy. So if you dial back the clock, we were a very innovative company that came up with a lot of cool stuff that we were not able to hang on to. So one sort of famous example is when cross-link foams were first developed, these people came to us and we innovated and developed the very first running shoe insoles ever done. And so in the early days, we made all of them and shipped them all over the world. But that business moved to China. And our customers sort of said to us, hey, you have the best materials in the world and therefore your insole lasts longer, but that doesn't really help us because if the insole wears out, our customer buys a new pair of shoes. And by the way, your perfect tolerances, although they're nice, they don't help us either because we just kind of step on it. So we started asking ourselves, and this is where our strategy kind of formed. We talked about this market to our sweet spot. Who values what we do? Which markets are the best fit where we add the most value and therefore can command the highest margin? So we picked a few. We picked automotive. We picked medical, picked aerospace and defense. And our logic was these were not going to go offshore. The automotive stays, the military stays, and the medical tends to stay. So we focused on these three. We quickly grew in automotive because one of these companies identified us as a super innovative company. And they actually assigned a member of their company to grow our business. They wanted to do business with us. So we had somebody whose job it was to integrate us into their business. And one of our big programs we did was the Mercedes-Benz SUV door panels. And that was a great program for us. And it launched our automotive sales. And we had some innovations around moonroof sunshades where with new materials, we changed from like 23 different parts, including ball bearings and clips, to like 2 parts. And it was like a breakthrough. And so we had a few of these things in automotive, but with automotive, the programs were shorter, 4 to 7 years, and there was immediate price pressure. And so with medical, we found the programs were longer and they were stickier after they go through the qualifications. And so medical seemed like a better fit. So we sort of de-emphasized our resources and capital away from automotive and more towards medical. Our acquisition focus became medical. And so the business sort of evolved and transitioned into medical. It wasn't abrupt. We didn't go out and take the first investment banking book with a very high multiple and say, we got to buy this. We were disciplined and diligent about finding good fits and trying to pay a fair price and not to overpay.
And if you go back to when you initially signed that deal, I mean, did you consider this kind of the jumping off point for medical and that it would potentially change your trajectory as a company and also the valuation? Or, was that not as clear, in hindsight?
No, we were executing our plan and, we were already marching towards more and more medical. The company was well over 50% medical by the time we bought these guys. And our previous acquisitions had all been medical, focused for one reason or another, either to get a material we were lacking. There was one material I can walk you through this story. So we saw ourselves as materials neutral. So if you come to us, we're not going to slam you into one material. We offer them all, and we pick the partner who's best. And so there was one material we were lacking. It was a special reticulated urethane, and they had very tight distribution, and they would not expand it. So there was about 10 or 12 people that could get it, and nobody else. So we went and interviewed these guys, probably 5 of them or 6 of them, the ones we thought that were the good guys, the good cultural fit. Not everybody is. We ultimately bought one. And then over the next 3 or 4 years, we bought 4 more. And we went from not having any access to the material to being the largest user in North America. So when we become strategically focused on something, we're locked in. We know it's the right thing to do. So, our strategy in this space had already been evolving. This was a medical grade of foam as well. And so, I'm aware that medical companies trade for higher multiples, and there's a reason. The business takes longer to win, and it's sticky once you do win it. So we knew as the business continued to evolve that we would be able to create more value for our shareholders, but we were executing a plan that we had started long before.
And in what ways has that deal, the Dielectrics deal, informed your strategy regarding subsequent M&A deals? I mean, have you looked for similar situations or where there was such a logical fit? Like, how else have you? How have your views evolved over time since that deal?
It has changed our opinion, because before we bought some companies that were making us more valuable for one reason or another, new material, new capability. But sometimes we were buying underperforming businesses that we thought we could fix. There were synergies, material purchasing power, and strip costs out. But this time we were very deliberately trying to be more valuable to our customers. And I think that it shaped our strategy. Now our whole acquisition strategy, the vetting point is, are we more valuable to our customers after we do this deal? Are we a better company? And so that guides us. It doesn't mean if we find an underperforming asset that we can fold into an existing plant and have instant synergies that we wouldn't do it. But that's not the focus of our search.
And you've talked about the M&A strategy overall a little bit, and talking about kind of vertically integrating and getting access to certain materials. So as you think about future M&A, where do you start to think about adding another leg to the stool versus just getting better and kind of going deeper in the products you already have so that you can be more valuable to those customers?
One of our big focuses now is, again, customer driven. And for a number of years, our customers have been asking this. They're saying that, hey, when our products reach end of life cycle, we're forced to cut costs and to take them to a low cost country. And you lose the business, and we have to requalify somebody. We go through all the risk. And then if you would be willing to be in a low cost country, you would save all that business, and you would have access to new programs with us. And so we've been a US-based company for a long time, but we started an acquisition search looking where we ship products. So we ship product to Ireland, we're looking at Ireland. We ship product to the DR, and lots of it, we've been looking in the DR. We ship product to Mexico, and many of our customers are in Mexico. So we were not successful in finding a deal in Mexico, so we decided to do a greenfield startup because we had committed to 3 separate customers on 3 separate programs that we would be there. So we've recently announced this. We'll be making parts in Mexico by April of next year, and probably within a year of that time, all 3 programs will be launched. So we are going to take this step into low-cost country, and we're going to execute on our vision of being able to deliver value to our customers at all stages of their life cycle. So we'll still develop, we'll still do U.S. manufacturing for early stages, and then we'll have this other leg of the stool.
And how did you assess the greenfield opportunity versus M&A in terms of returns? I mean, was that it? When you say you couldn't find a deal in Mexico, was it about the return profile, or you just couldn't find anything? I'm always interested in the buy versus build calculus.
Yeah, and so I'm 100% a buy guy. I mean, I have done a handful of greenfield startups. I think it's doing it the hard way. But if you have to pay a $10+ million premium for a business when your startup costs are only a couple million, it's just not worth. We'll save a lot of money by doing it on our own, and we'll do it quickly. And we de-risked it we've hired a guy who's excellent at this and who's done it before. So obviously a startup comes with risk. Obviously a startup in a new country comes with even more risk. We've used a third party in Mexico that does a lot of the work for us, that sources the building and signs the lease and finds the employees, kind of a maquiladora kind of startup. So we've taken a lot of steps to de-risk it. We will have to endure some losses during the startup phase, but it's not as bad as paying a $10 to $20 million premium for not a great business.
We talk a lot internally about companies, quote unquote, growing up. as they move from nano cap into micro cap and then even, into large cap land. Where do you think this company has grown up operationally? In what areas do you think it's grown up operationally over the last, call it 5 or 10 years? And where do you think there's still room to improve over time?
So some of the big strides we've taken, and sort of I'll give credit to our board who's pushed us to expand our talent and to, number one, to have better succession planning, but also to be able to grow the company. So we brought in 2 executives, both of whom were elected officers this past June. One, Steve Carden, was the former president of Viant Medical. Before that, senior VP of Ops at Vention. And he actually came to us through a director referral as well. So he's run lots and lots of plants all over the world. And he's in fact started plants in Mexico. And so he's brought to us a discipline around quality, compliance, program management that's helped us grow up as a company. And the second guy was an ITW executive, again, professionally trained at vetting new opportunities and finding synergies. And they're both trained in lean. And so the company's come a long way under these guys. And to answer your question about the next step, I think it would be around quality and compliance. And so these guys have pushed us towards, we need a super high level director of quality and compliance trained in med tech that can help us navigate through these, different countries and more sophisticated devices. So we'll continue to grow, and I think we'll continue to grow by adding talent that knows more than we do in their respective discipline.
You mentioned quality and compliance, and when I think of that, I think medical, there's all these regulations around it, and patient health is important, and so there's a lot of requirements from your customers. Would you say that as you've gotten more into medical, you've had to kind of up your game as a company to be just really precise, or was that part of the culture even beforehand?
Well, we've always had the various certifications to perform what we do in medical, and in fact, with Dielectrics, they were better than we were. So they make parts that go into the body. They develop quality systems and quality test equipment where we have 100% testing of every single device. But the more we grow up as a company, the more this function is more and more critical. And so, I think we're good. We want to be great.
And now a quick word about our sponsor. Before we started using the Tegas platform in 2017, CoStreet rarely used expert networks to find high-value sources to help us better understand the companies we follow. The competitors' offerings were expensive and limited. Tegas changed that dynamic through their innovative business model, allowing firms like ours with a more limited research budget to conduct expert calls at a fraction of the price of others. Tegas then records, transcribes, anonymizes, and posts the transcript to their platform for subscribers to learn from. Every new Tegas customer makes the platform stronger through deeper and richer transcripts, and I've personally seen the growth over the past 4 years. The Tegas network of experts and platform of previous calls has made the service an indispensable part of our investment process. In fact, we now use the word Tegas as a verb. If you haven't tried Tegas before, I highly recommend going to tegas.co for a free trial and to start Tegasing your research. I'm always interested in how companies try to evolve with their customers and how you create internally a dynamic organization that's not just like focused on the day-to-day, but actually taking time to look where the puck is going. So how do you think about that? How do you create an organization that is trying to anticipate to some degree where your customers are going, so that when they do have an order or something like that, you can be ready to jump on it?
We changed our structure over time with this in mind, where we sort of go to market by market segment now. And so the people that are calling on customers are very knowledgeable about their business, and they're experts in that field as opposed to experts in what we do for a living. Whereas the guys in the plants are more experts in the materials and the designs and stuff like that. So they're having high level conversations, and they're asking them all the time, hey, what can we do to be more valuable to you? What can we do to grow our business with you? And, they're very willing to tell you exactly what they want you to do, what locations they want you to be, what technologies you want. If you start doing this, the vendors we have in this are not doing a good job. And so they'll direct us. And so we will adopt a new technology for an existing customer. We won't do a new technology for a new customer. But if an existing customer says, hey, will you get into this? This is be helpful. We will investigate, learn it, and do it.
A question I neglected to ask you. What's interesting, I think you just said those 2 execs that you hired both came from much larger companies.
Hmm.
How have you been able to attract, kind of people who worked at larger companies to work at UFP, and what is the attraction to them as they start at a smaller company?
Yeah, good question. So we had to kind of break our own rules around compensation and pay what it took. We had to be, we were tired of getting underwhelmed by trying to stuff somebody into our compensation system. So we're like, this is the person we want. What does it take to attract them? And then the promise is we explain the vision. Here's where we're trying to go. Here's how you fit in. And frankly, if we don't succeed in acquisitions, and if we didn't do some of the things that we said we do, I'm not sure we could have kept these executives. And so we are delivering. They see the vision. They see where they fit in. They see they're part of the organization, and we move them along quickly. If you come into our organization and succeed, you get more responsibility very quickly.
And has your view of how to compensate people changed over time in terms of what metrics? I mean, I'm always a fan of companies that focus on some form of customer success in addition to returns on capital and maybe cash flows. How have your views on compensating people to incentivize exactly what you want as a CEO? How has that changed over time?
I would say it's changed a lot. I mean, I used to be kind of a low fixed, market to below fixed wages and way above market variable. So, if you came in and were successful, you were going to be able to double your salary in bonus. And what had to happen over time is to steal people away. They already had a mortgage and whatever responsibilities they weren't going to be able to go backwards. So you had to pony up on the fixed side and you could ease up on the variable. But so we had to basically pay a certain market wage to get these guys in. And so my incentive now for all my guys has drifted more and more to stock. So that's if the whole company succeeds, you succeed. And we have invested over a number of years. So it's got a golden handcuffs element to it. And so, their variable comp for them is primarily based on them achieving their goals and succeeding in their slice of the pie, but their ability to get rich relates to if the stock goes up. And I like that model. And we've pushed the stock down further and further and further. And every year, it goes down more, deeper into the organization.
And is one of the pitches to someone who works at a larger organization is that, yeah, you may not have all of these crazy resources that you had at this other organization, but you have the opportunity to be more entrepreneurial. How is that one of your pitches, and how does that play out internally if it is?
Yeah, I mean, we are by nature an entrepreneurial company, and I am by nature a delegator. So we say, this is your slice of the pie. And as long as you're delivering the numbers and following our plan, you can do it as you see fit. So they're like running their own business for their piece of the pie. And I think people really like it. They have a lot of latitude, again, staying within our culture to do what they want to do. And if that's what excites you, they thrive in our environment. So, it's the promise of being more involved and touching more things and being able to see instantly the value of your decisions. Your business is going to improve or not based on the decisions you make, and you're going to get constant iterative feedback versus in a bigger company, maybe not so much.
Going back to M&A for a second, because there was a question I neglected to ask you there as well, is so you mentioned that to some degree you have moved away from looking for fixer-uppers and looking for businesses that you don't necessarily have to fix up. What would it take for you to, or what does it take these days for you to think about buying something that's underperforming for a 50-cent dollar versus buying a good business for 90 cents on the dollar? Like what are the variables that would go into a decision like that?
I mean, if it's something that's already core to our business that we can do with our eyes closed and we can share best practices and get in there and fix it immediately, we would do it. So if you're a business similar to ours that's smaller, that has lost their way, but if it's a new technology, and that's really what we're trying to do, is we're trying to add more capabilities, there's no fixer-uppers. We're looking for the best of the best.
And I'm interested, you've done a number of deals. I'm interested in the cultural aspect of that. How do you deal with a fixer-upper and would you even deal with a fixer-upper that you felt like the culture wasn't right, in addition to maybe some operational issues?
Yeah, so if the culture is not a match, it's done. Like that's our number one screen. And, we assess it pretty early on, mostly from the CEO him or herself. If we don't think you have a similar view of the world and how you treat customers and the environment and people and your ethics, we just hard pass quickly. So we vet deals based on culture all the time.
And if you could define the UFP culture, I know it's a tough question sometimes, but I'd love to hear what that is and if that's evolved at all over your tenure.
I don't think maybe it has evolved a little. So I think our culture is the highest possible ethics, taking the high road in every single instance, honest people. We treat our suppliers with respect. We're not the ones that beat our suppliers into submission. We partner with them. We cherish them. We need them to survive. We treat our customers very well. And our employees, we try to make it a fun place to work. I mean, the HR departments, their assignment is to attract, engage, motivate, develop great people. And so, that's what they're all about. And so people know that we want it to be a fun place to work. We work hard to make it a fun place to work. And so, I think that's why over time we've had people stay a long time, why we have good tenure, et cetera. The thing that's evolved a little is as we've grown up as a company is it's been a little bit more of a probably a performance or results driven culture. And I think that's kind of a natural evolution. We still want to be a great place to work, but we are a results driven company. And so if you can put the numbers up within our culture, you have a lot of latitude to do what you want to do. But if you're unable to do that, we're going to send somebody in to help you. And if that doesn't work, we're going to have to put somebody else in your chair.
I want to move to corporate governance for a moment because you happen to be the chairman and CEO of this company. And it's always, as an investor, a question mark about, do you have the proper governance structures when you do have the combined chairman and CEO role? I'm interested, given that you live in both roles, what do you think? How do you think UFPT shareholders benefit from you being in both roles?
I mean, I know they benefit and I can prove they benefit, but I think that you have tremendous clarity when you combine the roles, and when you don't, there can be ambiguity. And if you don't have a unified strategy, and if you don't present strategies that are achievable and executable, you don't have that unity of purpose. And so, I was CEO for 12 years under a separate chairman. During the 12 years, the stock sort of tripled. It went from 1 5/8 or maybe closer to 2 to a little over 5. And then we combined the roles. And then over the next 15 years, the stock went up by 12x. And it was almost an immediate breath of fresh air when it all came together. So I know for our particular shareholders and our particular company, it was a significant benefit. I think that the reason it works for us is because we have a strong lead independent director. And that lead independent director meets with the directors independent of me every single meeting. They talk about, do we have the right CEO? Do we have the right strategy? Are we talking about the right things in the meeting? Does everybody have is everybody getting their topics addressed? And then the other, complaint people have is around compensation. If the board compensates the CEO and you run the board, your own governance on that. And so we, like most companies, have an independent comp committee. The board does not set compensation, only those 3 people. They don't ask for a vote from the board ever. So they use outside advisors. So the classic reasons why the governance might be light by combining them, we have addressed. We have a strong board and we have lively debate on lots of topics. So, I think our board functions at a high level. So I think that our shareholders are the beneficiary. If you told me tomorrow we're going to separate the roles, I'm not going to go home. I would do it, but I've lived it before and it didn't work as well. And I would try to sell my case about why it's better the way it is. And if they separate it, and maybe someday they will, I would just have to really get in sync with the lead director that, we're not going to try to come up with a compromise strategy that has a little of everybody's idea about which way we should be going. And I don't want to leave every meeting with a new investigation because somebody thinks we should get into injection molded paint cans, and the chairman, out of respect for him, says, listen, Jeff, at least put a committee on it. It may not be a bad idea. You can go off in too many directions. And so I think we're unified. I think the management team presents usually 3 different options to the board, and they vet, and we have one that we like the best, and they say what's bad about it, what's good about it. They push back and forth, but we leave with an executable plan and it works. So I think for our shareholders, it was a clear benefit. Maybe we would have done just as well if it was the other way. I don't really know. I think both are very viable. I have no objection to the other one. I just think for us, it worked.
In the beginning of that, you mentioned clarity of vision, which it's interesting to me because you're probably the third or fourth person who've been on the show who have said those words specifically. So for someone who would think that sounds a lot like corporate jargon, what I'm interested in, what is the opposite of clarity of vision? And have you, like, what do you think when you say that you have clarity of vision? What would, if you didn't have that, what would it look like? I just love some examples because it just, it just seems like so many of the companies we've talked to have that as like one of their core values.
Yeah, it's kind of almost like politics. In politics, there's all different kinds of compromise, and you end up with a solution that's not really great for anybody, but it's good enough. And you take a mini step forward. And so, like, if you try to run a company by a committee, you get a big watered down compromise. And so, the board plays a vital role, in governance. They play a vital role in choosing the right CEO, but then they play a vital role in supporting the CEO. If he's going too slow, they say, get going. If he's going too fast, they say, take it easy. If he has a plan that's got too much risk, so they have a vital role, but in my opinion, it is different than the management team's role. And so when you have the chairman and the CEO, same person, whatever plan the board comes up with, it's automatic unity that just runs through the company quickly. And so if you have kind of a rogue director that is not reined in by the chairman or a lead director to say, okay, we've heard your idea, but the board has voted and we decided to go south, not west. And, so now let's go. Versus, well, at least send a committee west and see what happens. It just dilutes the effort. So I like to spend time coming up with the right strategy, being very careful. And once you've decided, go and go quickly. And so the board's very vital in that slow vetting of what's the right thing to do. But after that, we want to step on the gas. It was kind of a business school case study on this, on like the worst car ever made. And it was done by committee instead of one person's vision, and it just came out sort of blah. And so I think the board's role is in making the strategy better, not creating the strategy, and pointing out pitfalls. And like I said, if the management team's going too slow, you say, giddy up. And if they're going too fast, you say, hey, slow down. And it's important, it's almost like a parental role. Like, you got to keep everybody in check. And they, they have metrics to see if it's working. We report in on the strategic goals every meeting. They have a dashboard of, red, green, so they have a good sense of what's happening if what we said we were going to do, we're actually doing. So I don't know. I feel strongly on this topic, but I know there's more than one way to do it.
You talked about how when a decision gets made, you're able to just take it through the organization without a lot of stops or people holding it back. I'm interested, as this company's gotten larger, have you had to fight against, it becoming more corporate in a way of like more processes and more procedures, and everybody's got to, and it sounds like, you've been able to kind of continue to make entrepreneurial decisions quickly, but are there any areas where you've had to kind of fight against it just becoming too structured?
Yeah, we live it every day. So like if you want to up your game, and let's just say program management, which we do, so you bring in professional program managers and they lay out a process for how things are going to get done. So you have the people doing the work who already have a pile this high on their desk. And the new hire that we spent money on didn't come and take a third of the pile away. He made the pile bigger, so you're kind of, as you're adding structure and discipline, you're adding work to the detriment of those people. And so, it's a painful process, and you have to make sure that the new guys aren't just dragging everybody into a meeting or not making good parts on time. And you have to make sure that the guys that are doing it are open-minded to a better way. And so it's a constant balancing act. And so, yeah, you can't give up on either. You can't give up on putting in the new systems to make you a better company, and you can't lose the good people because they get exasperated because you're asking them to do stuff beyond what they were already doing. So structurally, we kind of go back and forth. You go more decentralized until you feel like you're losing the value, then you go more central. You kind of move back and forth. We had an officer before who was kind of in charge of sharing best practices and operational excellence, and we went away from it. And now we have two leaders, one of medical and one of advanced components, and they do it on their own now. And so maybe over time, we'll feel like we're not sharing enough best practices and change again. But structurally, we have flexibility, but with our vision, we do not. And with our values, we do not.
So you've been CEO for a fairly long time, more than 25 years. I think continuity can be really beneficial, but having someone who's been CEO that long, can kind of cast a big shadow over the organization. So I'm interested in how you've tried to empower people who work for you to take initiative, and to as you think about succession planning, how do you inspire people to stay around and in this, under the heading that maybe one day they could be the CEO?
Yeah, so we have some very talented guys, each of which would be considered to be the next CEO. We have one that's kind of probably jumped ahead of the pack recently, was just named president of our medical group. So he kind of runs 2/3 of our business. I think the reason that we're able to keep him around is because he hopes someday he will get the job. And if he knew he wouldn't, I think he would 100% be working for somebody else. So our board's big on succession planning. He's been identified as a potential candidate. There are others that would like to be considered. But I'm pretty good at delegating and pretty good at letting others do things. So I'm more of an advisor, coach, and setter of strategy and placer of large bets, meaning acquisitions are huge capital spends. And the other guys, they run the business.
So you talked a little bit about the performance of the stock. I mean, when you became CEO in 1995, the stock looks like around $2. Stock's now over 60. I mean, that record trounces something like the S&P over that period. We've talked about some of the moves you've made and some of the cultural changes and evolutions, but I'm interested in if you had to distill the primary elements of that success that you've had, how would you categorize those?
I would say, well, number one is sort of the team of people. I think that my team's a great team. The team below is a great team. And I think our engineers are innovative engineers. But I think we've had a consistent strategy that's kind of iterative. And it's, this market to our sweet spot is designed to constantly look at the business. If you think of our business as a bell curve, which we draw on the blackboard all the time, there's the good stuff at one end that we're kind of getting rich on. So like, what are the attributes of that? How can we do more of that? The stuff in the middle and the stuff at the other end, like that we might be, taping dollar bills to every box that goes out the door. What can we do differently? Is there different design, different material? Do we raise the price or we just stop doing it? So our business has got this iterative process of constantly improving the book of business. And we distill it down to sort of 4 elements of our strategy. Great people, which I've talked about, aimed at the right things, which is this market to our sweet spot. It's very directed. Let's work on this because this is where we do well. Wow our customers with innovation and quality. So we keep our innovative roots. And the last one is get better every day. And this concept of iterating that we constantly have to improve. So no matter what the category is, even if it's shipping supplies, somebody's championing that. How can we get better at it? So we have a simple strategy that has not changed and that can weather different, we've had lots of recessions. I mean, we've lived through a lot. We can scale the business when we need to. We've demonstrated that before. It's a painful, no fun thing to do, but we have the ability to do it. So I think that we have a consistent strategy, and I think we have great people. And I think one of the reasons we have great people is our culture.
I'm personally predisposed to management teams and companies that have the willingness to suffer, which is willingness to make long-term investments at the expense of kind of short-term profitability. I'm interested in some examples of where this company has, clearly had a willingness to suffer short-term pain for long-term gain, and how that's paid off. Anything come to mind?
Oh, I can give you lots of examples. All right. So after having done 11 acquisitions, we found ourselves with like 13 factories, some close to each other, and just too many. And so we basically this is around 2016, called timeout and said, hey, we're going to do consolidation on the West Coast, one in the Midwest, and one in the Northeast. And we're going to get our platform in order. And by the way, since we're doing all this, we're going to change our ERP system at the same time. It's almost like we're going to pull into the pit. And so to do that as a public company takes a strong board, that's willing to say this is the right thing for the company to call timeout for basically almost 2 years, where you're gonna endure pain to position the company to succeed. And it was a great thing to do. Consolidations are not easy, and we make mistakes along the way, but we pulled off all three. We got the new ERP system, and when we came out of it, we were just on a tremendous trajectory going straight up. COVID interrupted it, but the platform is still there. And Mexico is another example. Mexico, if you're going to endure, a year or two of losses to start up a plant, some people would rather buy somebody and pay the enormous premium, but, we're going to do the right thing. We don't run the business quarter by quarter. And I think that consolidation, calling timeout, was a bold move, and it worked. And we explained it to our shareholders, but it doesn't mean some of them aren't going to run away. But we did do it.
Going back to that consolidation that you did, I'm interested how you got employee buy-in, because it's not just shareholders that care, but our employees are like, wow, not only do we have to do all this work, but our equity comp may not be worth as much as it was, or we get a 2-year pause on that. How did you get employee buy-in, and was it so obvious that it was unanimous, or did it take some convincing of people to get them on board?
With something as painful as a consolidation, this is what we are doing. It's an unfortunate, painful decision. Sometimes plants were 28 miles apart, and it was kind of obvious, but sometimes they were 3 hours apart, and a lot of people, were going to get displaced. But when you make an unpopular decision, you got to see it through. So we had conviction at the beginning at the management team level that this was the right thing to do. We knew we'd lose some employees. We knew we'd lose some customers, but we knew we'd emerge a stronger company. It's kind of the prune and plant kind of concept. So you can't waver once you decide this is what we're doing. We've got good reason to do it. And then you go. You
mentioned a couple situations in which you've made long-term investments at the expense of short-term profitability. Looking back, are there any opportunities or areas where you wish you had taken bigger swings, or you wish you'd been willing to suffer more for the long-term gain?
There's a lot of things I would do differently. Two come to mind. So one would be our molded fiber business. If I had to do all over again, I would have spent the money and hired a high-level president like I've done now, invested in guys and given him this business and let him or her run with it. Because I don't think we gave it the attention that it needed, and I don't think it necessarily reached its potential. It became less and less strategic, and so that would have been a good decision. The second one, from a strategic standpoint, we're in the orthopedic space. We mold foam that holds the knee or hip implants, and outside of every one of them is a vacuum form blister. And so we made a strategic, initiative way back when to get into that. And so we, knocked on the doors of the logical guys and said, we'd like to buy you, and this is why. And, they sort of said, no, thank you, we're not for sale. And, we didn't have enough tenacity, either hiring a third party or paying whatever it takes, because it was a good strategic decision. So that market grew, and quite a few people were successful. And if we had been, more aggressive, taken a bigger risk, we would have been in that business, and we would have bought the best of the best, even if we had to pay up for it. And we didn't. So that was a lost opportunity too. There's a bunch, stuff comes across our desk that, it's like a stock investment you wish you bought, or a house you wish you bought. So there's lots.
Irrespective of, a couple of errors of omission, which all investors make at times, this company's been very successful over the last decade or so, and I see managing success can be a challenge as well. How do you deal with, rising expectations of your various stakeholders, including employees? Is that a different thing to manage versus, turning around a fixer-upper?
The toughest thing is when you get, brand new shareholders at today's stock price, so you get no credit for anything you've ever done before. It all starts over. And so that's a natural process. I think of our company in longer term, segments. I look back like 20 years. And so, my team's kind of been together 20 years. 20 years ago was the end of a very difficult time. After 9/11, it's sort of 0102, our stock kind of hit a very low point after that. And, we've had this trajectory since where, it's far greater than the whole of my team's career. That one is going to be like, if we get the stock to 75, which we will, I don't know how long it'll take us, that will be 100x of that investment, in that 20-something years. So that's super exciting. So we try to win. We try to create wealth for our shareholders and for our employees, and we're competitive, and we try to have fun doing it. It's not always fun, but we have a consistency to our methodology, and it's able to weather different. Because we have this market to our sweet spot. If the sweet spot moves, like the puck moves, like we move with it, like we just change. So if automotive is no longer where the opportunities are, we'll just put our team over here. And so we adapt, and we have a platform that is adaptable.
Especially in a world today where, you can found a company in Silicon Valley and be a billionaire in a few years, and, whatever, everyone's making 1,000x. I mean, I think it's amazing. I think people think that a stock going up 20x's or 30x is something pedestrian. But honestly, most businesses don't appreciate intrinsic value like overnight, right? It just takes a long time. So I feel like your story is a story of patience. I mean, maybe talk a little bit about like how UFPT is a story of patience and how hard it is to really compound over a long period of time.
It is. I mean, we are a disciplined company, and sometimes when we go a long period of time without an acquisition, people get antsy, because our approach is too disciplined, and they don't know the one that went all the way down to the last minute and we walked when we found something we didn't like in due diligence. They don't see that. But we have been disciplined in our approach. We've never sort of over levered the company. We've taken a conservative approach. Maybe it's a boring company to say it doesn't grow like a biotech, but it does have a consistency to it. And I think that if shareholders, want to buy something and just put it in the drawer and not think about it for a while, they don't have to worry too much about our company, is what it comes down to. It's not a high risk bet, I don't think.
And despite the success, this company's remained a little bit under the radar. And I'm wondering if that's something that you think about or care about. Like, you don't do public conference calls. I mean, that's, no, neither does Buffett, right? So clearly there are other people who don't do that. But I'm interested in terms of like, some companies really care about liquidity. Oh, our stock doesn't trade. And maybe if our stock's traded, we could find other investors. How have you thought about kind of just building a company versus like whatever, making your stock more attractive?
So we've evolved in this category. So a couple years ago, we hired an outside advisor, this company, Three Part Advisors, who started introducing us to some shareholders on some non-deal roadshows. They host conferences. We did 3 of their conferences a year. We worked to get additional coverage. We just added Sidoti's coverage recently. We were at Sidoti. I was at Sidoti conference 2 days ago. So we are spending more time on it. I wouldn't say it's aimed at driving the stock price up, but I do want to drive up liquidity. And the reason I think liquidity is important is because there are investors who say to me, hey, our model requires us to be able to get in 30 days and get out in 30 days. And so it's math on how much we can invest. And so you got to get your liquidity up. And so that resonates with me. We mostly put our head down and try to run the business, but we need to have a stock that people can get in and out of when they want to. So you'll see us continuing to put work into that. Whether we do quarterly conference calls, we once did them. We didn't get a lot of value out of them. And we thought it was better to go talk to customers or potential acquisitions. We do get value out of the conferences. We do get value out of the non-deal roadshows. But if we get enough interest, we'd start them again. I mean, we want to have our story known, but we need to balance how much time we spend on that versus customers and acquisitions.
And do you think there's any benefit from, not having 15 sell side analysts covering you and just being, in the news all the time? Do you think there's a benefit from being insulated from that typical short-term Wall Street pressure that I think a lot of companies, there's so many of our companies are, to some extent managing expectations intra-quarter. They are, worried about next quarter's EPS, not because it means anything for the long run, but because there are a lot of other people that care about it. You think there's any benefit to, is that a benefit of kind of being under the radar, do you think?
I'd never thought about that till you said it, but probably, our CFO is probably less distracted than their CFOs. He's probably to focus on deals and whatever more. So yeah, if you don't have to put as much time into analyst calls and whatever else, there's a value. I have never lived that life of 15 analysts. I don't really know, but it makes sense what you say.
So I think anyone coming into the stock today or looking at this company today is can look at the past success and say, wow, these guys have really done it. But what are over the next, call it 5 years, what are 3 or 4 things you absolutely have to get right to continue the trajectory and to get to whatever 75 plus, like you said, that would make us 100 bagger? What are 3 or 4 things you absolutely have to get right?
We have to get this low cost country thing right. We have to sort of migrate from a national company to an international company, and we have to do it without fumbling. We have to do some scale acquisitions that continue to advance us as a company, and we have to attract some great talent along the way.
And we haven't really talked about aerospace, but you guys have been working to get more in that business. Obviously, aerospace is not a fun place to be at the very moment, but over the long run, you would expect that, Boeing and Airbus and the world will start, working again. Maybe talk a little bit about that. Where are you in that? What is the opportunity there? How are you thinking about aerospace going forward?
We combine aerospace with defense, and it's aerospace and defense. And right now, for us, defense is the exciting part of that duo. And so we're doing a lot of work with the U.S. military, particularly in cases. So they want a case for everything. And so, if there's a tank, there's a case that holds the toolkit, there's a case that holds the computer, And so we just got a large 10-year contract from the military to do ballistic panels that go into attack helicopters. And so, that's the size of your desk kind of case. It's difficult to do. You need specialized equipment. And so that's a good, repeatable, high margin. Not a lot of people can do it, book it and go. We haven't focused too much on aerospace for the last little bit because it's been a very distracted market, as you know. We do think there's opportunity there. We spend a lot of time, effort, and money to get qualified with Boeing and to get into their system and have their software and everything. And we're on their bid list for stuff that's in our wheelhouse, but there's not a lot going on there right now. So it's more the defense side that's exciting for us.
And you talked about 3 industries that were unlikely to get offshore: auto, defense, and aerospace, and medical. Are there other end markets that fit that criteria that that you could think about moving into, either through M&A or some kind of greenfield? I mean, are there? Yeah. What else could fit within that that not likely to be offshored rubric?
Yeah, we're not looking at that now because we're more into to further narrowing and further focusing on the medical side. So we're more looking at specific medical segments, like which segments are the best fit. We're really taking a big bet in robotic surgery, big bet in infection prevention, bet in negative pressure wound therapy in general, orthopedics. So we're more into segments within medical and finding the next segment as opposed to finding a brand new market. It doesn't mean we won't pivot someday and look at that, but right this minute, that's not on my focus list.
Switching topics for a minute, I don't think any conversation with a public company CEO would be complete without mentioning the letters ESG. I'm interested if there's any ways in which the companies has to evolve or change to meet the expectation of various stakeholders who are focused on ESG, or these things the company's been focused on for years, and it's really just about communicating with your stakeholders better.
Right. Well, no, we are spending time, effort, and resources on it like everybody else. We have a committee. We have our general counsel, who's also head of HR, who's sort of leading this charge and trying to get us better at it. The director, our last director meeting focused on director diversity. We already have 2 female directors, but we don't have one from an underrepresented group. And so we've vetted some candidates, and their decision was, I forget the quote. It was, let's move with a sense of pace, but not a sense of urgency, and let's get it right. Like, we're not going to run out and find the first, person that fits the minority bill if they're not going to help our company. So we are paying attention to it. It is important, but it's not the first priority in the board meeting, but it's on the docket.
And as you think about, leaving this company in the hands of somebody who, can take it even further, what would you like your legacy to be that person would be building off of? What kind of, is it either values or operational metrics? Like what would you like to leave the company with?
I would like to think that I was a custodian of the values created by the people before me, and that I kept them up, and that they would. I was not the founder of the values, but I was a custodian, and I think I did a reasonable job of keeping their vision intact. Um, we worked hard, and the guys that are going to take over, the guys that did it with me, to transition the company, from a more industrial company into a more medically focused, specialized company, and so those guys the guys that are taking over deserve the credit as well. But I'd like them to take over with the next couple of years, in the books. Like, they don't have to worry about tomorrow. Like the decisions we made today are going to make sure the next few years are great years. And so we're doing some smart things now that I think will pave the way for a nice period of prosperity. And I would like to leave somebody with the wind at their back as opposed to a storm brewing, because that's the way I would have. I mean, I came into a storm brewing. The company was in trouble. We were in bank workout, and it's tough, losing money. And so when I started, it was not a fun time. And so I'd rather leave things running well for the next guy, I guess.
And one way to do that is to have durable businesses that have some kind of moat around them. And this is a podcast called Compounders, and moats are synonymous with compounders. I'm interested where you see moats in your business, and how do you think about defending and widening those moats over time?
So we spend a lot of time on this. Our kind of philosophy is we want to see, is there an opportunity? Number two, can we take advantage of it? And number three, can we keep it? Back to our scar tissue about inventing good stuff and going up. So, we work hard on various. I'd say one of the keys is our material partnerships. So, the two biggest things we buy, really, cross-linked foams and reticulate urethanes, we've partnered up with people and have exclusives that last between 3 and 5 years. With Zote foams, 100% of their medical grades are with us. And with FXI, dozens of grades are with us. And so you can't just swoop in and steal our business without dealing with the guys that have already partnered up with us. Number two, our engineers. I mean, we've got 90 plus people on this team, that many of whom are homegrown. We have half a dozen new interns every year, and the best get hired. And so you can't just sweep in and hire somebody out of college and do what we do. Next would be our custom tooling and equipment. So we build equipment. So if you're going to steal our job, you can't go to an equipment show and buy the machine. You got to design it. So, we also have some IP. I don't have a personal great history of IP helping me. If we have a patent, it tends to make our customers mad that there's not equal competition. So even if we have them, it's almost like we have to keep it a secret. If we have, anyway, so we do have lots of patents, and we still pursue patents, but it's not our glue. It's just one cog in the wheel of our glue. So I think we have a lot of different layers of barriers to entry, or moats, as you call them, and we're constantly working on bulletproofing things. So that's a handful of them anyway.
And in an environment where there are rising costs just about everywhere within your P&L, the true sign of a moat is the ability to pass along pricing or raise prices. How have you found that so far as you're thinking about maintaining margins as costs are rising? Where are you seeing opportunities to take pricing?
So for our big customers, they're usually under contract, and there are material pass-throughs. So it happens systematically. But for the rest of them, it's incumbent upon us to keep it going. And so prices have been rising so quickly that we're only partway through the process of catching up on price increases. We're going through a comprehensive review again, and we're probably about halfway through it. And so we've passed on some price, and we've already absorbed some of the pain, and now we're passing on the price increase. In general, I'd say historically we've been quite good at it. It's probably hardest to do in the automotive space, but you can do it. You get threatened and whatever else, but you got to do what you got to do. If the materials went up, they can either buy your product or not. So it's a difficult time right now in supply chain. There's not enough materials, and so we just have to be really good at passing on the prices and strategically selling our value. So price increase is an important part of our strategy.
You talked about 3 or 4 things that you have to get right over the next few years, but I'm interested in what you're most excited about. Like what, you guys have a lot of different initiatives. You're starting up in Mexico. You've got, kind of a latent aerospace opportunity that eventually bounce back. But what personally, gets you out of bed every morning? Like this is an exciting path for us.
Yeah, I mean, it's difficult because we're a public company, obviously. But I mean, I'm most excited about our ability to continue to deliver on the acquisition side of our growth strategy. And I think that the work we have done over the last couple of years has uncovered some opportunities that, if we vet them and if we're successful, will make us a much better company. I'm excited about our product development business, the front end of our business that we used to give away in order to get manufacturing that we now sell for. And that business is growing rapidly. It's growing so fast, we're worried about staffing it. I think it grew 50+% last year. So, we're getting paid up front to develop with our customers. It cements our relationship with them. We make money at it. We learn when we do it, and we get business. It's a super exciting part of our business model. So I would say those two things. I'm excited to grow internationally and to grow up as a company and to take the next step. It may take some time to get that done, but we're sort of committed to getting it done. So I think we're at an exciting time. We have a strong balance sheet. We've got some exciting stuff we're looking at. We've got some new team members that are teaching us some new things. We got to weather, like everybody else, a challenging direct labor market and challenging supply chain, but the sun will come out again, and I think we'll be in a good place when it does.
And a quick question on the M&A side, since you mentioned it, how do you avoid getting into auctions and there's all this private equity money sloshing around? How do you avoid overpaying in an environment like that?
By not participating in auctions, basically. We go out and find companies that we think are a good fit, and we start a dating process that sometimes takes years, and kind of convince them that we're the right company when they're ready. And so we try to buy companies that are never marketed for sale. Now, very often they'll hire an advisor to test our price and stuff like that, but there'll never be a book put out on these companies. And usually when the book is put out, it means we're going to lose. Because there's always some private equity firm that's dying to put their money to work, and we see people overpay all the time, and then we see them unhappy 2 years later. I mean, there's lots and lots of deals where the private equity guys bought in our space and are not happy, more than the reverse.
And in theory, that's an opportunity for you to pick up those assets at a later date.
If they blow it out, but they can be disruptive in the market while they try to fix it, and I can't think of very many deals that were put out through a book that we were successful. One comes to mind, but generally, if somebody's going to go to a Piper Jaffray or whoever and professionally market, those guys are really good at extracting top dollar, and it's usually not us.
Well, Jeff, we've covered a lot here. I think we're going to close with our favorite question, and we've talked about a number of aspects of this company that may be underappreciated. But if you had to categorize, what do you think people miss most about this company or don't quite understand about it?
Unfortunately, some things that are confusing, like our GICS code has kind of got us placed in the wrong category. It doesn't show us a medical SIC code's correct, but so sometimes investors show up saying, thinking we're a packaging or paper packaging company. So we will get that fixed. We've been talking to those guys, but I think once they understand our company, what I think is misunderstood is the fact that we have this platform, this competitive advantage. We have the material partnerships, we have this engineering team. We have this network of plants that are, all the ISO standards for medical. We have this great customer list where we have 24 of the top 28 medical device customers already. And we have a strategy to kind of take advantage of it. And once we do take advantage of the opportunity, we have a strategy to keep it. So I think we have a platform that gives us a competitive advantage that most people don't get, that we have all the different pieces put together. It's hard to explain basically to somebody in a short meeting, why we're going to win and why we have something special.
Well, as a shareholder, we're interested in seeing what that looks like over the next 3 to 5 years. And hopefully this podcast allows you to get your story out to people who might not be familiar with it. So Jeff, this has been incredible. We talked about, I had to pull questions off of, out of the back of my mind because we covered so much. But thank you so much for doing this.
Thank you, Ben. Yeah, it's great. Enjoyed it. Take care.
That's it for our show today. We hope you enjoyed the conversation. We recognize that you have a lot of different podcast choices, and we appreciate you spending the time with us. We are continually working to make the show better, and we would love your feedback. The more candid and honest, the better. And if you have any suggestions for public company CEOs you would like to see on the podcast, please let us know. And of course, warm intros are always appreciated. Please feel free to email us at podcast at covestreetcapital.com with your comments or suggestions. Thanks again, and stay tuned for the next episode of Compounders, Anatomy of a Multibagger.